All righty. Sorry for the technical difficulties. We are right back at it. I'm not a big fan of technical difficulties, but we're just going to try to power through this call before something else happens. I'm not at my usual station, so I'm trying to make the best with what I got. I know it's a Saturday. I know it's the day before Christmas Eve. Happy holidays to all of you guys, and Merry early Christmas to everybody. We're just going to be covering an introduction to NAS100 trading so that everybody can keep their mind sharp going into 2024. Make sure that you're not falling off and you're not losing the momentum that you've already built. So we're just going to power through this. And yeah, if you have any questions, throw them up in the chats. I think today's going to be a very slow call. Just not expecting a lot of folks to hop on. So we're going to make this pretty quick. What I was just covering before the call timed out was the top 10 names in the NAS100 composite index and how that influences the directional movement and the velocity of how fast NASDAQ moves. I was explaining the difference between the different stock market indices. So you can see SPY, this is the S&P 500 stock market index. You have QQQ, which is Invesco's NAS100 ETF. And if you guys don't know what ETFs are, an ETF is an exchange traded fund, which is basically like an index that you can invest in. So the SPY, the S&P 500 ETF, allows you to invest in, SPX or SPX 500 without any leverage. You can do the same thing with QQQ, which is Invesco, which is an investment company's version of the NAS100 ETF. You have the DIA or the DJI, which is the Dow Jones Industrial Average ETF, which is US 30. The 1Q, which is the NASDAQ composite, not really as popular as the rest of the indices. So the top 10 names in the NAS100 index are basically the driver of the entire thing. So there's 100 stocks in there, but the top 10 are the ones that decide the direction and how fast this thing moves. So this list right here outlines those top 100 names by weighting. And the weight is basically the percentage of the index that these individual stocks make up. So 9.2 means that Apple makes up about 9.2, almost 10% of the entire NAS 100 index is just one stock. There's 100 names, but 10% of the index is in just one stock. Now we go through Microsoft, Amazon, Broadcom, Meta, Tesla, NVIDIA. Alphabet, which is Google, has two separate listings on the NAS 100 because they had some anti-competitive laws that dropped, anti-monopoly laws, and so they had to split their corporation in two different shares, and they also had some splits. And then we have Costco. Costco beating Adobe, Pepsi, Netflix, and the rest of the groups. Netflix used to be in the top 10. This used to be called the FANG stocks, which is Facebook, Amazon, Google, Tesla, Netflix, and yeah, those were the names. So if you look at just Apple and Microsoft alone, they're almost 20% of the index. You look at Apple, Microsoft, and Amazon, you have 17, 18 plus 5, about 22 to 23% of the entire index. Almost a quarter of the NAS 100 is comprised of these three stocks. So imagine the rest of the names in the composite index are not doing well. They're all crashing. They're losing investment capital. They're not beating their earnings numbers, and they're consistently underperforming the rest of the names. As long as Apple, Microsoft, and Amazon are doing well, the rest of the index will be going up. And so my expectation for 2024 is that NASDAQ will continue to go up as long as we have an easy monetary policy. The reason that monetary policy is so important for technology stocks is because when we all go to invest, if we believe that we're going to head into a recession, traditionally, investors will go into things called cyclical stocks. These are things that tend to do well during recessions, and they might do decently during non-recessions, but they'll survive the ups and downs of the market. These are things like toothpaste company, like Colgate, household products, toiletries, kitchen appliances, and things like that. Now, when you look at technology sector stocks, these are basically a bet on the future. This is a bet on the future direction of America, of American enterprise, and you're basically putting a long-term bet on technology. So typically you don't invest in long-term stocks and things that are speculative unless the economic environment is healthy. When we all have extra money in our pocket, we're going to look at the highest returning and highest risk assets that we can really make money on. If I invest in Colgate, for example, is that going to make me rich, or is that just going to preserve my wealth during good and bad times. See, the household appliance or the household goods, toiletries and things like that are things that will preserve wealth, but not necessarily grow wealth. If you look at these technology sector stocks, they have the highest percentage returns. And so this is where real money can get made. The higher the expected return of a stock, the higher the expected risk. So when we have let's talk about sentiment real quick. The market sentiment typically goes between two different modes, risk on or risk off. Risk on sentiment means that investors and institutions are willing to go and find risky investments like technology sector stocks and invest in those for the long term. When the market hits a risk off sentiment, typically investors don't look as much for long duration, high risk opportunities. They'll look for things that are more stable, things that are more cyclical. And that's where the risk off sentiment, people get away from high risk and go to safe havens. This is where you see the dollar tend to see a rise. You see gold, you see bonds tend to do well in this kind of environment because the market is prioritizing the preservation of capital as opposed to the growing of capital. So what does this mean for 2024? Traditionally, during low interest rate environments plus high money supply, this equals bullish NASDAQ. So when the Federal Reserve indicates to us that they're going to have an easy monetary policy going into 2024, what that typically means is that they're going to start reducing the interest rate or easing monetary policy, and then the supply of money in the system is going to be increased. Those two things are a recipe for bullish NASDAQ. So when I trade, I look at the fundamentals first so I can figure out the next 3 to 6 months directionally. A lot of people just strictly use their technical analysis in order to determine direction. I think that it's a little bit arrogant to do that, or it's a little bit ignorant to do that because you're ignoring the most important part of the market, which is the fundamentals. So low interest rate environment plus high money supply equals easy monetary policy, which equals a bullish NASDAQ. Now, high interest rate plus low money supply equals tight monetary policy, which equals bearish NASDAQ. And tight monetary policy can be seen as hawkish. That's the phrasing that traditionally macroeconomists use to describe a tight monetary policy. When the Fed gets aggressive, you can think of a hawk versus a dove. These are the languages that they use. You know, we have bullish, bearish, hawkish, dovish. To really explain those, it's very, very easy. A hawk is typically associated with more of an aggressive fighting style, where they typically are stalking their prey. They're just very, how do I say this? It's just a confrontational thing. So you can see as a hawk as being much more aggressive. A dove is typically seen as a sign of peace, and it's a sign of easy policy. And so when you look at easy monetary policy, which is the availability of credit in the system, banks can borrow, individuals can borrow. In a low interest rate environment, we're all getting new mortgages, we're all getting new car loans, we're all getting business lines of credit. In a high interest rate environment, when the Fed is being aggressive, when the Fed is being hawkish, they are tightening the monetary environment. They're typically reducing the amount of money available in the system. And that means that all of us, we're not borrowing, we're not spending as much, and we're definitely not borrowing money for business operations. And that's when NASDAQ starts to suffer because less spending means the stocks that make up the NASDAQ are not seeing as much business. So going into 2024, this has been the big question, is whether or not the Federal Reserve is going to continue to have easy monetary policy, which is kind of what Jerome Powell told us in the most recent December Federal Reserve meeting. Or if inflation remains high, we're going to go into this environment. So right now, the majority of the market, what we call consensus, which is what most people are agreeing on, is this easy monetary policy, which would lead to a bullish NASDAQ in 2024. If inflation continues to get higher, if the inflation crisis gets worse, and there's a few things right now on my radar that could send inflation going through the roof, then the Federal Reserve is going to have to get more aggressive and that would lead to a bearish stock market. Okay? Put a 1 in the chat if we're all on the same page about easy monetary policy versus tight monetary policy. This affects everything. If you've been waiting to get a house, the tight monetary policy environment, this is not for us. If you've been looking to get a new mortgage or to sell your house and move somewhere else, this easy monetary environment, this is going to be the best for us. The most important thing that I'm trying to cover here is that the markets typically move in 3 to 7 month stints, and if these cycles. And if you can understand the fundamental backdrop, you can have a reasonable assumption of what the market is going to do over 3, 6, and 12 months. And so while a lot of people are guessing the highs of a market, while a lot of people are trying to anticipate a turnaround, I just trade the trend until it ends, because the primary focus for me is I'm making decisions based on this risk sentiment framework. Okay, looks like the folks on YouTube are getting it. Drop a like real quick so that this stream gets sent out to as many people as possible so we can all have that learning environment. Now, I'm going to show you a live example of easy policy versus high policy or tight policy, just to show you the market reaction to the Fed policy decisions. I'm just going to use this as sort of like a historical context here to explain what's happening. So in 2008, we had a financial crisis, and this was the first time the Fed started printing money. So the concept of money printing already existed in different forms. There was something called open market operations, where when the Fed needed to pump money in the system, they would go out and buy high quality assets from the banks and from the open market and just pump them with cash. Now, what happened in 2008 is they took that. So 2001, we had the dot-com bubble. 2008, we had the Great Financial Crisis. Now, if we look at this chart, the Great Financial Crisis, which was the worst economic event that America and the world had ever seen, it looks like a blimp on this chart. Look how small that looks. This is what almost destabilized the entire world. We've already had bigger crashes than that in the past 3-4 years. Okay, so from a historical perspective, in 2008, Obama inherited by far the worst situation of all time. Wall Street had completely ruined the economy. Wall Street had put us in such a high-risk environment that, yeah, as much as people want to talk about Obama's policies at the time, his foreign affairs policy, yeah, we can criticize. But if you get handed the world's worst recession ever, and they're like, yep, fix it, that's a tough job. And so they dropped 2 programs on us that were meant to bring the economy back to health. Number 1 was the TARP program, which was basically a bailout for the banks. The banks had become something called too big to fail. They were so integrated in the economy, in the investment sector, that we couldn't just let them go under because it would destabilize the world. And so the TARP program was a lifeline for these banks. The second policy that was implemented was something called quantitative easing, which now we refer to as QE. QE was this bastardization of the open market operations policy, where they would go buy assets in the open market and pump cash in. Instead of only going for the highest rated securities and mortgage-backed securities, they started buying everything. They were buying shitty stocks. They were buying mortgage-backed securities, which are these investment pools that are secured by real estate. Now, the real estate market is crashing in 2008, and so the Federal Reserve was just like the buyer of last resort. What happened is the quantitative easing happened in different sections that we call facilities, like the QE1 facility versus QE2 and QE3. Now, over the last 14 years, we had 3 quantitative easing facilities that were implemented to get the market back on track. In 2018, so this is what happened. QE1, 2, and 3 had pumped about $4 to $5 trillion into the economy. And we were back stable. As much as people hated Obama-era policies and some of the socialist ideals that were implemented, we were able to get the economy back on track. The world did not destabilize. We were able to pass some very important legislation like the Basel Accords and the Dodd-Frank Act, which basically separated a lot of these risky operations. So for example, a commercial bank like Bank of America had to separate its wealth management arm from the traditional commercial bank. And so that's why Merrill Lynch and Bank of America are now 2 separate entities, but owned by Bank of America. That's why JP Morgan, the investment house, versus Chase, the commercial bank, are separated. And so when you look at things that way, you start to realize we did everything we could to try to get the economy back on track. Now, in 2018, Jerome Powell was the Federal Reserve Chairman. He had noticed that we were headed into an inflation crisis because we had printed so much money in QE1 to QE3 that all of this free money had ended up in the system and was causing price increases that were unsustainable. Housing prices went up over this 14-year period. Stock prices went through the roof. If you owned any assets in America, you were doing well from a relative perspective. Now, in 2018, Jerome Powell saw the inflation crisis that we ended up dealing with coming, and he tried to raise interest rates for the first time. A big problem here, guys, just to add this extra little detail that's very important, is that credit was essentially free for the major banks. So if you were Wells Fargo at the time, or you were Bank of America, you could go borrow billions of dollars for free from the Federal Reserve. What does that mean? When we go to get a mortgage loan today, 3 years ago, mortgage rates were around 3 to 5%. Today, they're anywhere from 6 to 12%, depending on your credit score. And so borrowing money for free means the banks could borrow at 0% interest and go loan it out to people for 3, 4, 5%. And that's how they were making all their money. In 2018, Jerome Powell tried to raise the interest rates for the first time in 10 years, and the market punished him for it. We had it really requires us to zoom in now because of how small and insignificant this looks. But the 2018 crash happened in two parts. The first part is when Jerome Powell said that inflation was a major issue and we're going to crash the markets and he's going to continue to raise rates. The stock market punished him for it. Then the stock market started to recover a little bit, thinking that Jerome Powell was not serious about his fight against inflation. They were like, he's not going to raise rates again. Lo and behold, Jerome Powell raises rates again, and we have another major crash. This is when Jerome Powell showed us that he was not willing to take on the pressure of crashing the economy for real. And as soon as we started to see the effects on the stock market, Jerome Powell eased off in his language, said, okay, maybe inflation is not that big of a deal, and maybe we're going to get through this. And so they went back to an easy policy. All right. So we were going through an easy policy. I was talking about the inflation crisis all 2019 because anybody with even an ounce of, that was paying attention could realize how bad of a problem this was. In 2020, in March, we had the coronavirus crash. This basically was any hope that we had of fixing the amount of money that we pumped into the system and undoing all of the damage completely went out the window because the Federal Reserve implemented the fourth quantitative easing facility in March of 2020 to stop a global depression. Here's what's important. QE4, this fourth QE facility, was greater in size and in velocity than QE1 through 3 combined. Which means that in 2020, we pumped more money in 2 months into the economy than we did in the 14 years prior. Put a 1 in the chat if you guys are still with me here. This is crucial. This is the environment that we live in today. When you look around and you see the inflation crisis and you see stock market highs and you see the housing market that's just way too expensive for people our generation to be able to buy a home. And you're asking yourself, how did we even end up here? How do we get in a situation where everything is this expensive, where housing prices are this expensive? How does that even happen? This is how it happens, is that we printed more money in 2 months than we had in 14 years prior, and we completely bastardized the economy and pumped $17 trillion. Here's a fun fact to kind of drive this home. Over 33% of all US dollars in circulation were printed in 2020. So if you think about the 100-year history, you think about of the dollar, you think about the Bretton Woods Committee that made the dollar standard the global reserve standard. You look at all the money that's been introduced into the system for years and years. You look at the three quantitative easing facilities that happened between 2008 and 2020. And you take all that, we pumped more money in the system in 1 year than the entire history of the dollar prior to that. 33% of all dollars in circulation today were printed in 2020. Isn't that insane? So when we ask ourselves, why did we deal with an inflation crisis in 2021 and 2022? I've been writing about this for years. You guys can go to our website and go and check a lot of the articles I had put up years prior where I was discussing this phenomenon. Let me show you all this real quick because this is important. You got to be able to show that you understand these concepts in real time. I'm not talking about this just from hindsight because everyone's an economist or everyone's a genius in hindsight, right? I was writing about this in real time. I'm just gonna grab these articles here. Um, 10-step mindset guide, analyze the current market landscape, inflation, elections, tight labor market. Okay. So this is prior to oh no, this is 2023. What is this? Let's go fundamentals. 2020 elections. I'm not gonna spend too much time on this. I just want to show you guys here. I was writing about Brexit in real time, the dollar squeeze in real time, the gold trap, the Corona crash. This is 2020. This is right after the coronavirus crash. So we had the top concerns that I was looking at, bond market, China trade war, et cetera, et cetera. And I had my predictions here for every currency class. JPY, this was by far the best call of the decade. All right, I'm not going to be able to find it without wasting too much time. But long story short, in 2019, we already saw an inflation crisis. We already saw that we were headed into a problem. The coronavirus crash was the nail in the coffin. The most important article I wrote was about the coronavirus crash that said the corona crash, why this crisis could lead to the worst economic event we've ever seen, which it did. And so the reason why the COVID crash could lead to a systematic crash in global supply chains and bring on an economic depression. This is exactly what happened. So the supply chain crash that happened was China closed their borders. Europe was not allowing cross-border trade. And so all supply chains were shut down. But stimulus checks were getting sent out to everybody. People were still getting paid from their job, even though they weren't at work. And so everybody had money in their pocket. And so demand for goods was high. People wanted stuff, but we couldn't get stuff because the supply chains were completely screwed. Shipping lines were closed. Shipping ports were backed up. And the price of getting goods into the country went up 10x. 10x was how much more expensive it was on supply chains during the 2020 pandemic. So the phenomenon that we saw for inflation was high demand, too much money chasing too few goods. Now, the basics of economics is that if you have demand higher than supply, prices go up. And if you have too much supply of something and not enough people want it, you got to lower your price to make it more attractive. So we saw the prices go high because there was limited supply, plus this massive demand spike that we saw because of the money that was getting pumped to people's accounts. Okay? So is everybody clear on why we had inflation? It was a two-sided coin. We had the supply side dynamics and we had the demand side shock. The demand side sort of like boom. So in all of 2020, they're pumping out this money, and in 2021, they're still pumping this money. That's when I started writing about the inflation crisis and how the Federal Reserve was absolutely losing its mind. Here's the pandemic aftermath article. This was written in 2020. Okay, so ever since the first markets were around, we had a mania. I said a bubble is a natural part of the economic process. It's supposed to rebalance supply and demand while cleaning out all the unproductive parts of the economy. So towards the end of 2020, I was already calling for a major crash. And keep in mind that in 2020, we were still bullish. We were still bullish through all of 2021. It wasn't until January 2022 that we started to see this dip back down. Bubbles are going to happen regardless. It's up to the Fed to control them and make them more predictable. The reality is that corporations and banks have always taken the money and bought back their own stock to increase their share of the economy. What this has led to is a perfect correlation between Federal Reserve action and stock market recovery. Basically, I was just saying that whenever the stock market or whenever the Fed prints money, stocks go up. Whenever the Federal Reserve does not print money, stocks go down. And the biggest reason I pointed to was because when the corporations are getting money from the Fed, they're using it to buy back their own stock, not to go hire people and invest in research and development like they're supposed to. The conclusion is that the rise in US indices is not due to optimism about the future, and it's not representative of the economic health. Instead, it's a representative of Federal Reserve printing money and that same credit getting locked into the equity markets. This means that the stock market has now become a better gauge of wealth of the rich as opposed to the health of the Main Street investor. Ain't that crazy? Which is why the wealth gap went insane during 2020 and 2021, because the more stocks you owned, the richer you got, the more real estate you owned, the richer you got, et cetera, et cetera. Now, what happened in 2022? In the summer of 2021, the inflation in the United States had reached 9%. 9% is unsustainable for any economy, but especially the United States. The goal is about 2% a year. 9% inflation means that the currency is losing 9% of its value and goods and services are going up by 9%. If you have $1 billion, you're losing $100 million of value a year in purchasing power. Let me say that again. If you're a bank with $1 billion in cash, you're losing $100 million of purchasing power every year. That's not sustainable. So what ended up happening is in 2021, myself and a bunch of other economists were saying that the Fed needs to shift their policy ASAP. And they just kept it rolling. They kept it rolling. They kept it rolling. And then in December, Jerome Powell had a chance to calm the markets down. And instead of going up in the December Fed meeting and telling folks the truth, he basically gave us the Santa Claus rally. The Santa Claus rally is now a famous term for what Jerome Powell does to ease the markets towards the end of the year. And then January, he found the first stage he could. He went to some economic policy conference and told everybody that inflation had now reached an unsustainable level and that in 2022, they were going to start to raise interest rates. Now, we just spoke about this, just to kind of do a final recap. For 14 years, we had easy monetary policy. We had almost zero interest rates. And so banks and corporations were borrowing for free, and there was just an abundance of money in the markets. All of a sudden, 14 years, a lot of the professional investors and CEOs had never been in an environment without free money. And so no one really knew how to react in this moment except for veterans. And what we saw in 2021 was that the most seasoned CEOs of, IBM, of the big banks, they all stepped down because they knew what was about to come and they wanted to end their run on a good note. 14 years of crushing it. Let me hand off the company to some schmuck and then let's have them deal with this next crash that's about to happen. So in 2022, the announcement that we were going to shift our 14-year policy over to a tightening policy, that led to a massive crash. And then again, massive crash, as Jerome Powell continued to reiterate. Now, they didn't actually start raising interest rates until the summer of 2022. The dumbest thing I've ever seen. They did not stop printing money. They were still pumping over $100 billion into the economy every month this whole time. $100 billion a month into the economy, $100 billion a month, $100 billion a month, until the summer of 2022. Now, as soon as they started quantitative tightening, which is the opposite of money printing, it's like having a vacuum to the money in the system, sucking it all out. The market started to recover. This is one of the most important events that I've ever been a part of, besides the Corona crash and obviously this whole period. The market starts to recover. Jerome Powell goes to the annual Jackson Hole Conference, which is an economic conference out in the Jackson Hole, and he was talking about the state of the economy. The very last question during the Q&A portion was some young dude asking him why the stock market was pumping if Jerome Powell believed that we were going into a very tough 12 months. And Jerome Powell had to tell the whole market that they were getting ahead of themselves. The stock market pump was irrational. And that's what led to this. The second he said it, the market started to just crash out of the sky. Okay. This was a very interesting period because I actually didn't gauge the bottom of the market correctly. I saw from a technical standpoint that we had reached lows, and so I had stopped selling. But even here, I didn't really believe that this was a genuine recovery. It wasn't until the market had pumped up, and at some point in 2023, I conceded, okay, because we broke above the previous highs. And that's when I started to realize, okay, this actually might be a shift in market direction. So all I did was wait for these higher lows. And then all of 2023, we were going long again. Now, let's put a bow on this entire conversation and talk about what's going to happen in 2024. What we've seen now is that the markets are forward looking. When the markets believed that Jerome Powell was going to raise rates, they started selling off earlier. When the market believed that Jerome Powell was going to start tightening the economy and taking money out, the market started to sell off before the summer. Keep in mind, up until the summer here, the Federal Reserve was still pumping $100 billion into an economy that was dealing with an inflation problem. What happened around this time, one of the big reasons I feel like we had a recovery is we had a banking crisis or a small banking crash with regional banks. We had Silicon Valley Bank go under. And so what happened is that the Treasury and the Fed kind of worked together to bail out the banks. So all of the money that they had taken out of the economy between the summer and October and November was all pumped back in the span of a week. I'll show you guys. Federal Reserve Bank lending facility. Let me see if I can actually find a chart here. The chart is crazy because it shows that we made massive progress. Discount window lending. Let me see if there's a chart here. No, here's what I'm looking for. Let's go Federal Reserve balance sheet. Let me see if I can actually just look at this straight from the balance sheet. This is March. Can we do a 5-year? Okay. It doesn't matter. This is the 2020 crash. You guys can see that the Federal Reserve's balance sheet went from $4 trillion all the way up above $9 trillion. So we almost doubled the Federal Reserve's balance sheet in just a span of 1 year. All right. And then over here in 2021, we continued to do the same thing. And then 2022, this is when the Fed started to reduce their balance sheet. And I don't even think that we can see it on here because I'm looking for the bank lending facility. What we'll basically see once I find this chart, I'll go through it later this week, is that we started to see a dip when the Fed started to reduce their balance sheet. And then as soon as the banks went under and they had to go and pick up a lot of those assets and pump money, we saw a massive spike back up. So all the progress that was made trying to take money out of the system got undone in the span of 2 months. What this shows us is every time there's an emergency, the Fed will shift their policy and they'll undo all the progress that they've made. So in 2024, here's the big concept. The markets are forward looking by about 6 months. And so they're betting on what's going to happen in the future. This big spike that we've been seeing since February. And then obviously in the summer, we started to see a bit of a sell-off here and then a recovery again. What this is showing us is that the Fed is betting that next year we're going to have easy policy. Now, at some point in the next 6 months, the market is going to break these highs, and then we're going to have a massive retracement where the market will just consolidate above the highs. This is what's going to happen. In this consolidation period, the market is going to be betting that the Fed is going to get more aggressive in 2024. If Jerome Powell goes on stage in January, because the next big event for us is the January Fed meeting, and he indicates that they're going to cut rates in 2024, then we're going to see a continuation of this trend and pump, baby, pump. If Jerome Powell indicates that they're not going to raise rates until 2025, which was the original assumption. The original assumption was the Fed will not raise rates, the Fed will not cut rates until 2025, because we don't want to risk inflation coming back up. Inflation is like a bad virus. And if you don't finish your antibiotic cycle, it's going to keep coming back. And so the whole question is, are we going to finish our antibiotic cycle in 2024 and completely crush inflation? Or are we going to do a mediocre job and allow inflation to come back? And so these are the two scenarios going into 2024. A lot of people are guessing, And what I would tell you is you need to have a multiple scenario framework where you are not imposing your own expectations on the market, but instead you are responding accordingly to whatever the market presents us. If Jerome Powell has easy policy, we're going to be buying NASDAQ every morning, wake up and buy. Hashtag wake up and buy. If Jerome Powell is going to start tightening or not raise rates until 2025, then we're going to have a sell-off for 3 to 4 months before we continue the bullish trend, in which case we can't keep forcing buys because then we will lose all of our money and get crushed. Put a 1 if you guys now understand the importance of understanding the macroeconomic cycle, of understanding these 1 to 2 year sort of stints that the market goes on in order to, best understand how we should trade. And if you understood, like, y'all, I was buying crypto at the lows, and this is how I made most of my money in the crash. Timing these crashes is unbelievably difficult unless you're well versed in fundamentals. And even still, it's tough. But if you can catch these turnarounds, that's where the big money gets made, because it's not like you're going to put in a micro lot size here and get rich, which used to be my goal. And that really was a good goal to aim for. Now, my goal is not even just to catch the top, but just to understand the trend so I can keep waking up and either buying or selling for 6 months without having to keep rethinking which direction the market is going. All right, if you're on YouTube, guys, please drop a 1 if you guys understand this. If this is completely confusing and I lost you, God help you, because it ain't going to get easier than this. All right, last thing I want to cover is this article here. This is how I made most of my money. This is April 2020. So if you guys see where April 2020 is, April 2020 is right here at the lows of the crash. I was telling everyone to buy cryptos at the low of the crash. Why? I'm going to put an arrow here to point to where April 2020 is. April 10th or April 13th was right here, right before this massive pump. Okay, this is where I wrote this article, right before the 2021 pump and the 2020 pump. This is where most of my money got made again, because the market for Bitcoin had reached 13,000 that same year, and the all-time high was at about 20,000. During the COVID crash, the market crashed all the way down to $3,000. So when I say crypto comeback, why Bitcoin? Why now? I went through the whole thing of why Bitcoin exists, the Byzantine general problem, the history of Bitcoin, and the evolution of blockchain, the biggest players in the game. And then what's next? I was calling this from back in 2020, how JP Morgan Chase and Enterprise and some of these other big companies were starting to invest on the low, but they weren't telling anybody. Okay, the global credit system collapses due to an inability of countries to restructure their debt as a result of monetary policies. Developed countries around the world are going to lower their interest rates to 0 or below. This is why I said that Bitcoin was going to pop off. If any developed nation doesn't follow, then it's going to create an imbalance and it's going to crush their economy. So I knew that everyone was going to start to drop their rates. I also said that quarantine creates a remote working environment. Privacy, consumer data, sensitive material, classified materials, internal documents, and personal data is going to be at risk, which is why it's going to be a big, big time for NASDAQ and for cryptos because of the privacy. And then there's a rush to safe haven investments. Gold and crypto are going to see a rise in price, which is exactly what happened. Investors are going to rebalance their portfolios and try to reduce it. The price of a Bitcoin at that moment was $6,000. And so I kind of did the math here about how many Bitcoins exist and the price per coin, the total market cap needed to see these prices. So in order for Bitcoin to hit $50,000, which it did, we would need a $1 trillion market cap. In order for Bitcoin to hit 100,000, which is the next step for us, the Bitcoin market needed a $2 trillion market cap. So I was looking at the market caps and saying, at the time of this, the market cap was 145 billion. And so as we started to see it climb, it became more and more realistic. Okay? The conclusion is the Federal Reserve policy of easing in 2009, it changed the way our economy works. The current cycle of quantitative easing is going to really just exacerbate the wealth gap. and it's going to force society into an alternative money system. Because if this didn't exactly happen, it's not going to, we did not force society into an alternative money system. We forced society into an alternative investment vehicle. Our parents' parents could go buy a house for $15,000, and that was their wealth creation vehicle over time. That was stripped from us and our generations. And so instead, we force society not into an alternative money system, but an alternative wealth creation vehicle. The government is going to try and impose, this is how spot on I was. This is 2020, guys. The government is going to try and impose their own form of digital currency. If they can successfully regain public trust after the crisis, then the implementation will be successful. If the public does not trust the new currency systems, then there will be an emergence of a shadow currency network that will create structural problems for the government. That's exactly what's happening, which is why America is so harsh on the crypto companies today, because they tried to create an off-ramp for Americans, and the American government did not like that. So the main point is to understand that there are major structural changes coming to banking, commerce, credit, and currency, and it's going to be in investors' best interest to have a hedge against the collapse of the dollar. Make sense? So this was when price was at 6,000, and I think I even wrote another article, which is why everyone should own Bitcoin. I'm trying to find it here. Crypto comeback, pandemic aftermath, US dollar gridlock, why everyone should own Bitcoin. So I told, this is in March of 2021. And so this is a little bit later here. This is like towards the lows of this area here where we had a massive retracement, and I was kind of loading up on more cryptos, okay, before the pump. Granted, we had a massive sell-off the month after I wrote the article before the market went and reached new all-time highs. I had made a prediction here about how the market was going to hit 100,000. So the year ended up, with Bitcoin jumping from 6.4 thousand when I wrote that article to $28,000. Okay. The price is currently at 48,000 when I was writing this article. Everyone should own Bitcoin due to its trajectory over the next 5 to 15 years. Companies like JP Morgan, Fidelity, MicroStrategy, Tesla, Square, Goldman Sachs are all investing in Bitcoin and launching their ETFs. The real reason why Bitcoin is going to pop off is because of these 5 main factors that I indicated, which is the virality, which is called the network effect, the Lindy effect, which is essentially the longer that something's around, the longer it's going to continue to be strong. Inflation, as inflation gets higher, so will assets. Scarcity, Bitcoin has a scarce supply, and so price is going to go up. And decentralization, which makes it resistant to a lot of the geopolitical wars that we're seeing. All right. Here's all of the questions about Bitcoin explained. I know some of you guys are a bit more skeptical about Bitcoin. And so the questions that you would get from a very smart person would be, what if someone hacks the Bitcoin system? Bitcoin is never going to be a good payment mechanism. What if the government makes Bitcoin illegal? What if they print more Bitcoins? What if I lose my information and my money is lost forever? Bitcoin uses too much energy and is bad for the environment. What if the government makes their own Bitcoin? Right? So I address every single one of these piece by piece to really try and address the heart of why Bitcoin is the most dominant asset over the next 10 years. I know this was supposed to be a NASDAQ masterclass, but understanding how inflation impacts high-risk assets allowed me to put crypto and NASDAQ in the same bucket. Where crypto is no longer the highest risk and NASDAQ is no longer this traditional stock market asset, they were both seen as high risk, high reward. And so what if the government makes their own Bitcoin? This is not an if question. Governments are currently building their own CBDCs, and the issue with CBDCs is that they're centralized and owned by a central party who can control how you use, store, spend, and invest your money. The value of Bitcoin comes from the fact that it's decentralized. This means that no currency is allowed to impose its will. My parents don't know how to use this stuff, so it'll never work. What's the biggest threat to Bitcoin today? And so I mentioned that the 51% attack, which is a globally coordinated simultaneous attack on every mining pool in the world. This will never happen. We went into a global pandemic and the world couldn't even fucking agree to keep us all alive. They couldn't even agree on a policy that was central enough to have a consistent global policy. So no, the world is not going to have a coordinated simultaneous attack on every single mining operation in the world at the same time. Okay. The biggest corporations and how much they own. We had the Grayscale Bitcoin Trust. Shout out to America really allowing crypto to thrive up until the last year and a half. MicroStrategy, big shout out to Michael Saylor. Tesla, you guys know Elon was buying as much Bitcoin as he could. Galaxy Digital, big shout out to them. That's Mike Novogratz. It's a Canadian-held crypto digital holdings company. Square, Marathon Payment Group, Marathon Patent Group. Marathon is the largest mining company in the entire United States, and the Hut 8 Mining Group. These are the largest. Then I mentioned the wall of money. This is the one that's relevant to 2024. A wall of money means that there is enough cash on the sidelines waiting to get in, and all they're waiting for is the Federal Reserve to give us the signal. When we see what happened this year with Bitcoin's price popping off, the wall of money hit. Same with stocks. When we see the stock market price completely explode, the wall of money that was sitting, waiting on the sidelines during this sideways period here, this entire sideways period where the market was sort of trying to figure out if it was going to continue or not, the wall of money was sitting there and just waiting for the right moment. Once we had the right indications, we started to see the pop. There's another wall of money that's sitting on the sidelines because of this high interest rate environment. Venture capital firms, private equity companies, pension funds have not been investing as aggressively. That money is sitting on the sideline waiting to find a home. And that's what we're going to see. If we have the right news in 2024, that money on the sideline is going to pump all the prices, and we're going to see a massive, massive push going into the first 2 quarters of next year. Okay. That's it. Okay, here's the one last thing. There's other sectors of crypto and blockchain to pay attention to. There's DeFi, which is decentralized finance. These are all the companies I'm looking to invest in. Chainlink, Uniswap, Ren, some of the other big names. We have NFTs. This is before the NFT pump. This is in 2021. I was investing big in NFTs, pumping my equity, like how much money I had, selling off the NFTs and putting that money in the cryptos that I actually believe in for the long term. Decentralized applications, these are huge. Long story short, Bitcoin will have reached 80,000 by January 2022. I was off. I was off by a little bit. Bitcoin did not hit 80,000 by January 2022. Instead, towards the end of the year, we maxed out at 70,000 or 69,000. So was I close in my prediction? I was pretty close. Was I 100% correct? No, it's very hard to be 100% correct. So this, ladies and gentlemen, hopefully was an understanding of how Federal Reserve policy impacts markets, how looking ahead and having a good framework for understanding fundamentals can help you navigate these markets, and how I'm going to be using this knowledge over the past 10 years and over the past 7 years of me being involved in crypto and other markets to navigate 2024, to make 2024 my $1 million trading year. All right. It only takes 1 year to have an exponential growth in your trading. I've made enough mistakes in the past to know exactly how to navigate this. And I'm just trying to keep myself in check so that I don't enter 2024 overly excited and I can continue to have this success. All right. 2024 is going to be the year of following the plan, of not over leveraging and giving the money back, and really, really taking advantage of the big movements that the market's going to give us. Put a 1 in the chat if you guys learned something today. Drop a like and a subscribe if there was any value provided to you on this stream. And of course, ladies and gentlemen, this is day 90. Day 90 out of 100 for the live streams. We've been streaming 90 days in a row. Very, very happy to have all of you guys along with us. We're going to continue the next 10 days strong, finishing this 100-day sprint. And of course, we're going to continue to stream well into 2024. If you guys are on YouTube, throw something in the chats real quick, just in case, just so I can make sure that everybody learned something today. And even better, just to make sure that we didn't waste our time today, because after this, go spend time with family. You guys are going to go watch random shit. You're going to have conversations that have nothing to do with your financial well-being. And so drop one thing in the comments section, something that you learned on the stream today. Make it one phrase, make it a word, make it kind of like just a lesson that stuck out to you, something that rose to the surface of information that resonated with you personally. Drop something in the chat so we can all verify that you guys took something away from this. Because again, guys, the conversations you have in your daily life, ask yourself, the conversations you're having this week. Oh, so how's everything been? So what's new in your world? These are great questions, right? Catching up with family and really spending time with your loved ones. But you do need to prioritize your success. How many conversations are you having that are going to directly impact the money you make next year? Look at your current life circumstance. Can you afford to take your whole family on a vacation today if you choose to? The answer is no. You got to ask yourself, how can I get better going into next year? How much more serious can I take my role as a trader? So set good goals so I can actually have financial success next year. Not just make some money, my first payout, whatever. Really make money. All right. He said, I'm out. Have a great time. Just throw something in the chats that you guys took away. And I think that'll be very beneficial for everybody. Traveler Trader says Fed's decision and impact on high risk assets. Beautiful. If you didn't take anything else away, it's that is the most important thing. Fed prints money, stocks go up. Fed don't print money, stocks go down. Okay. And you can look at the NAS100 chart relative to the Fed's balance sheet. Okay. And you can see that the rise and falls correlate with the stock market rise and falls. You have the Fed printing money. In 2019, you kind of had a little bit of a dip here when the Fed was trying to get rid of some assets. That's this right here. Coronavirus crash. We had a crash and then a massive recovery. So this big recovery up starting in 2020 correlates with the Federal Reserve's balance sheet popping off. There's a bit of a decline here. Correlates with the decline in the stock market performance. Low interest rates plus high money supply equals easy monetary policy. Let's go, Frenchie. I love that. James said forward-looking fundamentals. Yes, the markets are 6-month forward-looking. So don't look at whatever the market is doing today and say, oh, the Fed is, or the market is betting on this and that. No, they're betting on something that they expect to happen in 6 months. So what is that? Khalees said accumulate some crypto. Yes, but now don't throw all your money into crypto at the highs. Keep in mind that dollar cost averaging is how you can take advantage of these market pumps. Because imagine if you have $1,000, you put $1,000 up here, and then the market starts to retrace. That's when you lose all your money, and now your $1,000 is now sitting at 500 or 600. Dollar cost averaging means if you have $1,000 to spend or to invest, you'd put a $200 here. And then if it starts to crash lower, you can put 300 here. And if it starts to crash even lower, you can put $500 here. And when the market reverses back up or continues back in that direction, you can be in profit on all your positions. If you throw in the 1,000 here and it starts to retrace, now you're sitting at $400 and you don't have any more money on the sidelines. So dollar cost averaging is your best friend. Definitely don't put all your eggs in, and don't lose all your ammo at the high of the market. Accumulate some crypto. I love to see it. Mad value. It's rare to find someone who breaks down fundamentals like Roy. Jared, I really appreciate that. Thank you, brother. 33% in 2 years. So 30% of the total money supply was printed in the last year and a half. That's fucking disgusting. And it's a great takeaway, Sabo. Great stuff. Lee Pereira says wall of money is on standby. Yes. There's 2 walls of money I didn't cover, Lee. This is going to blow your mind. The baby boomer generation is about to pass on, essentially meaning that when they retire and then when they pass away, the money gets re-put into the economy. This is the beauty of estate taxes, death tax, and some of the other policies in America. So the money is either going to end up in a charitable trust, which is like an inheritance fund for their kids. You'll still pay estate taxes. So the amount of tax money that's going to get sent in, the amount of money that's going to get spent in the economy before they have to give it back to Uncle Sam. Because if I'm a billionaire and I have a choice to give $500 million to Uncle Sam for taxes, or to go spend this $500 million and give it all back to the game, I'm giving it back to the game. You're out of your mind if you think I'm getting hit with 50% estate taxes. So there are trillions of dollars. The largest wealth transfer in American history is going to happen over the next 5 years. If you have a business that can take advantage of all this money flowing in, you will become massively successful in the next 5 to 10 years. Now, on top of that, that money is also going to find itself in stocks. Pension funds are going to see massive inflows. And that's where you want to take advantage of owning assets in America. Owning assets in America so that when they print the money, instead of being a brokey and having to just pay higher prices at the store and complaining about inflation, which is what most people will do, right? You have an extra $100 a month because you're living paycheck to paycheck. The price of gas went up. Now that extra $100 is going to gas. You cannot live that way. Make as many sacrifices as humanly possible so that you can be in the asset class owners. Because the people that have houses, stocks, and crypto, when the money gets printed and pumped in, they don't panic. They don't complain about the rise in prices. They're happy that their house went from 400,000 to 500,000. They're happy that their stock market portfolio and their 401k went from 100k over to 170,000. And so be an asset owner and take advantage of this inevitable inflation instead of, complaining about it or just being a victim to these high prices. All right, Roy, what do you think about this kind of testing the cart, going on the back and day by day journaling every day plus and for 5 months, explaining the mechanic strategy, one trade a day, you are on a plus. Okay, so what I would do, Joss, I don't really understand the full question, but I think I do. If I have this correctly, you're asking about this kind of backtesting. What I would say is there's two kinds of backtesting. I explained this in the NAS100 masterclass, which, by the way, registration's about to end soon. You guys can use promo code CHARTADDICTS. Use promo code CHARTADDICTS to grab your seat to the NAS100 masterclass. If you guys think this free value is important, wait till you see me break down a step-by-step strategy for you to guaranteed make money in 2024. If you don't take this masterclass, I just think that you either have a profitable strategy and you're crushing it, or you just don't care enough about your success. But side note, if you're going to backtest, there's two kinds of testing. There's random testing, which is basically just going back and looking at the different days and just asking yourself, what happened? What does the market do? Now, when I was developing my strategy, I random tested. Random testing is just basically like, how does the market really work? Strategy testing or specific testing is what I do now. And this is what I encourage everyone to do during the masterclass, because I tell you guys, be a student, not a follower. Just because I'm telling you this information and I'm successful does not mean that you should just blindly trust me. That's how we deal with so many problems in the Forex world today, is everybody is just believing what someone says because they have a good presence on social media. No. You have to be a student, not a follower. So strategy testing means you go back and take this step-by-step system that I've outlined, and you go day by day and session by session and use that strategy and see, does it work? So the market pops off at the market open, and then it comes back to retrace to the Tokyo session lows, and we look for the Fibonacci retracement. And that's the step-by-step. Now you're going to go to every New York session for the past 100 sessions and try that strategy and ask yourself, out of 100 times, how many times does the strategy play out? When you guys buy a strategy from another influencer, whoever it is, go and test the strategy day by day and go back and back test it for 100 different days and ask yourself, out of 100 days, how many times did it work? And what you guys will find is that most of those strategies that they're trying to teach you are either a failing system or they don't show up often enough, and it's going to lead to over trading because you're going to be impatient. And so it's just not practical to use. The NAS100 886 strategy is the single greatest system I've ever used. And it's the single greatest system I think I've ever taught. And so that's what I want everybody to make sure that you guys learn a profitable strategy going into next year. And the best way to do that is to find a strategy and then test it every day. And you have 3 weeks before the markets pick back up. You have 3 weeks to really commit to learning what you need to know. The February masterclass is going to be that chance that we have to get you started correctly. To get you started the year off correctly. When the February volume comes back in, you have a strategy, you have a plan, and you have a guaranteed system to make money. All right. So make sure you guys grab those Chart Addicts promo code. This is going to be the success strategy for next year. One last reminder is that the FX Summit 2024 tickets are now active. It's going to be November 15th to the 17th. We have about 11 months going into next year. You have plenty of time to save up for the trip and to plan, ask for time off, and everything in between. I want to see everyone, especially my folks from the States, to show up to the FX Summit conference. We're going to have Bob Elliott and a ton of billionaire investors speaking. We're going to have Umar Ashraf and a bunch of his colleagues that are some of the most notable retail traders that we know speak on stage. We're going to have Michaela from Binance speaking with a ton of folks from other crypto companies. I want to put together a broker panel between Oanda, Forex.com, and I think either Ava or Saxo or one of the big brokerage houses. And last but not least, one of the things to look out for, well, 2 more panels to look out for at the FX Summit conference. I have a funded traders panel. Next year is going to be Kyle from Jade Capital. He's made over $750,000 this year from trading prop firms. And then we have Pascal, which has made over $1.5 million trading prop firms this year. And I want these folks to get on stage and really break down how they're different than everyone else. These guys are not affiliates for any prop firms. They just trade and rob these prop firms blind. Okay. And then last but not least, I want to do a prop firm CEO panel. So I want to get the CEO of FTMO, the CEO of the Funded Trader, of MFF, maybe not MFF since they're in some legal trouble and I don't really trust them. But we'll find the ones that are reputable, get them on, maybe Funded Next, and we'll have a panel discussion of just the prop firm CEOs. Okay. Come and talk on stage there, Roy. I was on stage 15 times in the in the last FX Summit conference, guys. Trust me, I'm no stranger to being on stage. The tickets are 50% off until the end of the year. You have about 9 days or 8 days left to secure your tickets, guys. Do not sleep on this. The ticket prices are going to go higher than 2,500. We have so many VIP ticket holders that are already reaching out on the wait list that these are going to sell out before anything else does. So if you guys want to get your seat, this is highly discounted. Make sure to grab those. And I mean that from the bottom of my heart. That's an opportunity you do not want to waste. If you guys want more information, there's the galleries here. You guys can see me. I've been on plenty of stages. Okay. I've been on plenty of stages. This is Pierce Crosby, the general manager of TradingView. You guys can see that TradingView shirt, shining proud. We also had the founder of Oanda, Dr. Richard Olson, come and speak. We had this, this is before the beef, obviously, but the FIP sort of private meetups, people hanging out with Q Banks at the VIP events and just like being with the boys. You get to see tons of companies promoting themselves and sort of talking about the industry as a whole and really learning how this industry works. Obviously, supercars and the rest inside the halls. You get to talk to all these big name traders. We have car shows, Lambo Rob Wool, this is your boy right here. All right. Jas said, I want to be on that stage, Roy. Well, Jas, what I would consider is send us your track record or send us whatever details you have regarding your own trading results, and we'll consider you as a speaker on stage. Now, I'll be honest, guys, it was a lot easier to be a speaker a few years ago. As the reputation of the summit continues to grow, I am prioritizing. I am 100% prioritizing the quality of the speakers on stage and just finding the folks that have a story that just knocks our socks off. And people that had a significant impact on my life. And so here, the people on this stage specifically had an impact on me because Andy really showed me how brokerages worked in the back end and helped me develop a kind of an understanding. Luke Longmire, as much as people hate him, I actually learned a few things from him in the 1 month I had an IML, and he was successful at the time, had a 51 trade winning streak using gold, kind of trading it. Jessica Lane opened schools in Africa. She bought a Lamborghini Revoluto for 700 grand cash. She's been trading. I talked to a bunch of her students who are making 6 figures plus on verified brokerages, and they all attributed their credit to Jessica, the standards that she set, the discipline that she promoted, and the trading plans that she helped everybody develop. So I have a very, very big affinity for Jessica, and I think having her on stage was awesome. And of course, when James turned $50,000 to $1 million, he actually was at my house. He flew in from New York. We were doing podcasts together and hanging out, and I saw him run up that account live. So when everybody wants to talk shit about whether it was real or whether he did it or not, let me be the first person to say that I saw it with my own eyes. And it was not on KOT Forex. It was on Nash Markets. Not that saying that Nash Markets is reputable at all. But I am saying that it wasn't on the platforms that everyone was manipulating at the time. Okay, so highly recommend you guys check out the FX Summit Conference. Next year, we're going to have the top funded traders, the top crypto investors, the top crypto companies, the biggest prop firm CEO speaking, the biggest prop firm payout holders speaking, and of course, retail traders from all around the world. I can't wait. We're going to be doing a world tour as a preparation for the FX Summit Conference. And of course, if your city gets called up, even if it's an hour away, I recommend you guys showing up and hanging out with some of these big traders because we're going to be bringing the essence of the FX Summit worldwide to you. Ladies and gentlemen, great to see you all. Happy and safe trading and happy Christmas or Merry Christmas and happy holidays to all of you. Make sure you spend time with loved ones and enjoy that. Will I be streaming tomorrow to finish off the 100 days? People, when I say I'm committed and I'm disciplined and I make no excuses, that means I will be streaming Christmas Eve. I will be streaming Christmas Day, and I will be streaming on New Year's. So ladies and gentlemen, let's finish off this year strong. Let's keep the momentum running, and I appreciate you all showing up on this beautiful Saturday to improve your understanding of markets. Take it easy. Happy and safe trading. Peace. All right, CA members, quick fix up. Obviously we had a slip with the